You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogotrade, an extraordinary value in online trading. Why pay more for the same trade when Sogotrade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody. I love to hear that music. I love to hear that theme because I know that means it's time once again for Options Bootcamp. My name is Mark Longo from the optionsinsider.com, as well as from a little thing we like to call around here the old OIRN. That, of course, stands for the Options Insider Radio Network, upon which you are listening to this fine program and many other programs, hopefully, on the old network. We're up to 13 now. Crazy. Hard to believe, but new programs all the time, including our new Trading Tech Talk program. If you ever wondered really what powers these trades that you're executing here in the options market, what powers all of the stuff you see going on in all the different financial markets, could be equities, could be options, futures, what have you, all of the cool tech that powers that stuff. We talk about it all there on Trading Tech Talk. Got a great guest coming up this week, so I think you guys are going to like it. Check it out, Trading Tech Talk. And while you're there, be sure, speaking of technology, be sure to download our new Options Insider Radio Network mobile app. I know a lot of you already have checked it out and are sending us great feedback through the app. Of course, you can instantly stream all of your favorite episodes of Options Bootcamp. So let's say you're going to work and you say, wait a minute, what did they say about straddles on Options Bootcamp again? Well, you hit that button and it's right there for you at your fingertips. You can also download it for offline listening on your commute, on the train, on a plane, wherever you like to listen to this fine program. And of course, you hit that contact tab and now you're directly in contact with myself and John and Dan and all the other fine hosts on this program. And you can send us your comments, your questions, your feedback. Maybe you don't like Dan so much. You can put all that in there. And we'll, of course, route it to the appropriate show. So check it out, the Options Insider Radio Network mobile app. I think you're going to like it. And joining me on the old Options Bootcamp panel today, the drill instructor squad. Starting off with the aforementioned fellow that you all love to hate, none other than Dan Passarelli, the major domo over there at Market Taker Mentoring. Mr. P, welcome back to the program, sir.
Good to be back. You know, this show does need a villain, so, I'm happy to oblige.
You are he of the dark hat, sir. I'm just kidding. Who couldn't love Dan Passarelli? He's so lovable.
Ah, shucks.
And also joining us on the old program today, the man holding down the Sogotrade.com hot seat, none other than the options specialist extraordinaire from Sogotrade, Mr. John Critchley. John, welcome back to the program, sir.
Howdy, folks. Excited to be back. Great show today. Good topic that I've dealt with actually in the last week or so. So I think it's very timely for a few of our customers at least. And looking forward to it.
Yeah, it's going to be a fun one. So without further ado, let's get right to it and dive right into our basic training segment.
It's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir! You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir! Call in. Prepare to learn. Yes, sir!
All right, it's 4th of July every episode when we start off the old basic training segment because we just get in that festive Yankee Doodle patriotic type of mood. And we were thinking about it before the show about what really is a good timely topic, something that we haven't really discussed on this show to date, but that is still very, very important for a lot of you basic retail options traders out there. And we kept coming back to one thing, and one thing only, and that is dividends. A lot of you have written in with various questions over the years about how dividends impact options, and so we thought it'd be a good time to sit down and actually talk about that exact subject. So let's start off with the basics. How do dividends impact options? Well, the first thing you need to really know when you're talking about dividends and options, a lot of you out there are used to buying and holding dividend yielding stocks, so you collect a dividend. It's part of the strategy, it's part of the income stream that you can have from that stock. We've also talked on this show in the past about generating your own dividend income stream on a particular underlying by writing calls on that particular name. And now you're doing a covered call, or maybe you're doing a wheel, selling the put first and then selling the call to get out and generating income on that stock as well. That's also an income stream, but that's not really a dividend. You're kind of creating your own dividend. We call it that, but it's not really a dividend. And the reason we don't call it a dividend is because if you're an options holder, you're an options investor, an options trader, you don't get dividends. And that's the key takeaway from today's episode. If you buy a call on XYZ stock and it pays a heavy dividend, guess what? When that goes X dividend, you're not going to get it because you're not entitled to it as an option holder. Only the holders of the underlying are allowed to collect that dividend. So that is going to frame our discussion today around options and dividends, because all of the ancillary impacts of dividends on options come through their impact on the stock. What happens when a stock declares a dividend, what happens to that underlying, and then what in turn happens to those options prices as a result, because that's really where you need to focus if you're thinking about options and dividends. So let's just dive right into it, Dan, because I'm sure this is probably a question you get a lot from a lot of your very basic first-timers over there at Market Taker Mentoring about how these things actually work. So why don't you walk our listeners through the basics of how a dividend on, let's say, XYZ underlying will impact the prices of the calls and the puts?
Well, at its most basic level, you have to appreciate the fact that stocks potentially pay dividends, but options absolutely do not. So if a company's officers decide, hey, you know what, we've got cash, we're going to make it our policy to pay a dividend, maybe it's just a special dividend, or maybe it's a quarterly dividend, then, hey, if you're holding the shares on the X date, you get the dividend on the payable date. The X date, of course, being 3 days before the date of record. But if you're holding a call on the X date, tough toenails. It doesn't really matter. The exchanges create options contracts, and people don't really realize this always. Options contracts are completely independent of the stock. Like the CEOs of companies don't decide to list options on the companies. The exchanges do. The CEOs might not even realize that they're being listed. I'm sure they do. I'm sure they, keep up with what's going on with their stock, but they have nothing to do with it. So that being said, there's a formula that holds all this together. It's called put-call parity. And the idea is if I buy a call and sell a put of the same strike price, that's synthetically equivalent to being long the stock. So if I buy like the April 50 puts and sell the April 50 puts as well, same strike, same month, it's like I'm long the stock. But the difference is you have to accommodate a couple things. The difference is there's a cost of capital associated with shelling out all the money to buy stock. So you have to factor interest in. And if I buy the call and sell the put, I don't get the dividend like I would if I held the stock. So I have to factor that in. So a good, pretty useful trader formula for put call parity would be something like a long call plus the strike price minus the put, which would be a short put, minus interest, plus dividend equals long stock. So basically, you kind of have to add the dividend into the option side of the equation to make up for the fact that you're not getting the dividend by holding the option position, which you would if you hold the stock position.
Are you introducing basic algebra to the show, sir? I thought I said no algebra at the top of the show.
Yeah, I tell my students, hey, you know what, I try and keep everything as simple as possible. And, there was a little bit of math there, and it might have sounded a little overwhelming, but, when you just sort of look at that formula and think about it a little bit, it becomes real approachable really fast.
Yeah, it sounds intimidating, but a lot of that you can factor out. Interest rates really haven't been much of a factor for the better part of the past half decade or so. So you can kind of scratch that part of the equation. When we talked about synthetics back a few episodes ago, we didn't even really focus on those two parts of the equation. Now, John, you mentioned this is pretty top of mind for you because a lot of your clients are calling up and writing in with questions about dividends and options. So why don't we start there? What are some of the really salient points that are coming from your clients? What are they confused about? What are they calling you up about when it comes to dividends and options?
Well, the one thing I want to mention is that if we all recall, last year, Apple had announced a dividend. And when that happened last year, we had customers calling up, and I think I actually wrote about it a little bit. What does that mean for the option marketplace? And the quarterly dividend, I think, was $2.50 or $2.65 or somewhere in that range. And basically what happens is, and what I told the customers is that the dividend, when they announce it, that will decrease call values and increase the put values. And the longer dated options, the one that have more time and more dividends will fall into their expiration. They'll be affected the most than the nearer term options. So that's how for someone like me, I watch dividend announcements very closely because we'll get customers calling in and saying, what does that mean? What does that mean, special dividend or whatever the case might be? So we have to explain that to them. I mean, there's a lot of different tentacles to this discussion, and I'm sure we're going to get into, but the basic idea of call values decreasing and put values increasing when dividends are announced is paramount to this discussion. And maybe Dan or Mark can go into it more depthly, but it's back to what Dan said about the algebra and put call parity, but that's a key idea to understand.
Yeah, that's kind of really what I was getting at before, is that basic tenet of what happens with a dividend and how it impacts the option prices. That's really what a lot of our listeners really need to focus on when they're thinking about how dividends impact their trading. And, dividends come through in a lot of different ways. For example, like we said, the XYZ stock, they declare a dividend. Let's say XYZ is trading at 50. They declare a surprise $1 dividend. Now, you as the option holder need to decide if it's worth your while to actually try to capture that dividend. Let's say the XYZ 50 strike call that you own, stock's trading at 50. And let's say, because Dan was talking about put call parity before, we'll just boil it down to its essence here, which is really the shorthand for determining how much extrinsic value, which is what you're really looking at here on the strike, is to look at the put. In this case, they're both at the money, but let's say in this case, that call is trading for $1. So now you have essentially a wash. If you exercise that call, you lost $1 worth of time value, but you collected $1 dividend, so it would probably be a scratch. Wouldn't be worth it for you to exercise that call. Now let's jazz it up a little bit. Let's say that they declare a crazy dividend, $5. They're going to declare a special one-time dividend of $5. You're sitting there along the at-the-money 50 strike call. It's worth $1, and you say to yourself, is it worth my while to exercise and get that stock to get the dividend? Now you look at the math and say, well, I'm giving up this $1 because remember, when you exercise your option, you're not selling it. That's why we say it's always better in most scenarios, except for dividends. In most scenarios, it's always better to sell your options in the market rather than exercise them because you're getting that little bit of time value you have left in the option. If you exercise it, you're just losing that. You're giving that away. So you're giving away that $1 in the value of the call, but you're getting the stock, which is going to collect $5 worth of a dividend. So in that case, you're net profiting $4. So it makes sense to have that on. Now let's reverse that role for a second. A lot of our listeners like the covered call strategy, or maybe just naked short calls, whatever your preference is. When you're short calls, dividends can also become a factor for the exact same reason. Let's say XYZ trading 50 again. And now you have your short, let's say the 51 strike call in this case, which is worth, let's say, 10 cents. You sold it for $1, it's decayed your way, and you're thinking, should I take this off? Yes or no? I don't know. It's still have a dime to go. I want to collect all this decay. And so you want to let it ride. You want to collect that last dime. Pigs get fed, hogs get slaughtered. Now XYZ comes out with that same scenario, that same $5 special dividend right before expiration. Let's say you have a couple of days to go, and this option otherwise is going to go to zero, and you're letting it decay to zero, and it's going to be worthless. All of a sudden, they declare this special $5 dividend. Well, guess what's going to happen? You're going to get assigned on that 51 strike because people are going to exercise that strike in order to capture that dividend. An option you may have thought was going to go out worthless, or a short position that you hadn't really counted on turning into short stock. Well, guess what? Now you have a short stock position on that strike. And this is what happens all the time. We see this every quarter with SPY. People forget that there's a quarterly dividend on those indexes, and they get caught with short calls getting exercised against them that they weren't planning on. And they come in that following Monday morning with short stock or a short ETF position in that case that they weren't planning on having. So that's something very much to keep in mind and be cognizant of if you're doing a lot of the strategies we talked about here on the show, like covered calls or just naked short calls in general, because this is where dividends can get tricky, and this is where they can come and mess you up if you're not paying attention and you're not aware of the impact that dividends can have on your trading. Dan, anything you want to add to that about the impact of dividends on, let's say, covered calls or on calls in general, or when you want to exercise to capture that dividend versus when you don't?
Yeah, I mean, one thing to consider is a lot of people who trade covered calls, for example, they're trading covered calls because they bought, the stock 20 years ago and they own it for a cost basis of like, a penny, and now it's trading $300. And the last thing they want to do is sell it. So you really, really got to be careful to make sure that if you don't want to get assigned, you don't get assigned by buying back short calls that are in the money when you have covered calls. Just sort of one example to flesh out what we were talking about here. And you can manage that reasonably well, just adding a little bit of color to what Mark said. You kind of have to do the math a little bit, but sort of the bottom line is if you have a call that is short approaching the X date and you don't want to get assigned, if it has very, very little time value, well, you got a pretty good chance of getting assigned. So you might think about buying that call back and maybe sell it out after the X date. And then long options, the same thing. I mean, Mark touched on that quite a bit. If you want to exercise and capture the dividend, do it before the X date. You would only decide to exercise if you're not giving up too much time premium.
The one thing I wanted to mention, and there's one very easy way to when you have long, deep in the money calls and you want to exercise them. There's a rule of thumb that traders know, and Dan and Mark know, and Dan hit on it, is that if the dividend is greater than the price of the puts, the corresponding puts, then the trade may be worth doing. And it's relevant to my customers because I have one customer in particular who will sell in the money calls, relatively deep in the money calls, and as a stock replacement on the short side, and then buy out of the money calls. So he's doing he's doing a spread, but he's shorting the deep in the money calls. And then last month in, I think, Herbalife and ANF, he got assigned the stock. And he's like, why did I get assigned the stock? And I said, well, is there a dividend? And yes, there was. And the dividend was 20 cents in one of them and 30 cents in the other. And I said, well, that's maybe not so bad for you. And you make it lucky. If something happens dramatically on the downside, you now own the puts for the price of dividend. I know it's a little complicated, but the bottom line is that look at where the puts are trading if you're making the decision to capture the dividend. And Dan hit on saying that will factor in the time premium. So that's a little trick of the trade to see if you should exercise your deep in the money calls.
Yeah, that's kind of the best rule of thumb to use to judge whether there's enough extrinsic value to really make it worth your while. The example I used was an at-the-money option, but you could use it for any option you want anywhere. If you look at and say, hey, there's a dividend coming up, the dividend is worth X amount, and the puts on the other side of the strike chain there is worth X amount. You have to compare those two. If the put is worth more, then guess what? It's not worth your while to exercise because you're giving up the value of that put. That's all the extrinsic value on that strike to exercise. So you're gonna lose money net to collect that dividend. Whereas in the example I gave, you have some crazy dividend that's worth a lot more than the put on that strike. Then guess what? It is worth your while to exercise. So that's a quick rule of thumb. People are always writing in, hey, what's a good rule of thumb for this, rule of thumb for that? That's the best rule of thumb for when to exercise your calls to capture a dividend. Now, speaking of capturing dividends, one thing I want to hit on too, because we're talking about dividends and options, are these trades you may have seen, you may have heard us talk about in some of the other shows on our network, called dividend plays, dividend capture trades, whatever you want to call them. They're very large trades that go up essentially to exploit what we're just talking about, the ways that options can be used to capture dividends. And I won't go into all the mechanics because there's a lot of minutia involved with the way options are cleared and settled with how these trades work. But essentially what used to happen a lot when we were on the trading floor and now happens to much larger degree is people would come in right before X dividend date, which is of course when that dividend gets cut off, and say they want to capture a dividend in a stock. They will find strikes with a lot of open interest, usually deep in the money strikes. And a lot of times as market makers, people will come in, they want to buy and sell exactly the same option, usually a deep in the money call. So net, it would be a wash on your books. It would be a wash on their books from a position standpoint, from a clearing perspective. And remember, from a clearing perspective, you have a net open position and a net short position. So they would exercise the long and hope they would skate and not be assigned on all of the shorts. And whatever number of shares they didn't get assigned on, that's how much dividend they would collect. As you can tell from that, it's a very complicated, a lot of minutia going on in there, and a lot of fees associated with that, which made it prohibitively expensive to do. What happened a few years, about 5 or 6 years ago, a lot of the exchanges came through and pretty much limited the amount of fees they're going to charge on those trades. So all of a sudden, if you're going to do 1,000 contracts in a dividend trade, it became the same cost to do 10,000 or 1,000,000. So now we've seen these explosion in volume of these dividend trades going up before these ex-dividend dates to try to capture these dividends. And it's become a bit of a problem because they're going up in such size that they're becoming distortive to the overall volume numbers, as well as the people who look at options volume to try to gain some sort of strategy, some insight into the underlying. And any given year, these trades can account for 5 or even more percent of overall volume. A lot of people agree that that's pretty much a negative impact on the industry for a trade that really has no net economic value. You're really just trying to game the system and take advantage also of a lot of retail customers who maybe aren't sophisticated enough to know exactly what we just talked about, when they should exercise those calls to capture a dividend. So it gives the industry a black eye. It distorts volume. A lot of people are kind of fed up with it. So we've seen a big pushback against it in recent years. And we saw at the end of last year a proposal go through from the Options Clearing Corp to try to get rid of that little bit of gaming of the system that people use to push these dividend trades through. It hasn't really been approved yet. Once that gets approved, hopefully sometime this year, then we should see these trades start to go away. Right now, 5% of overall volume amounting to essentially fluff. That's not a good thing for anybody, and it's just distortive overall. John, do you ever get any people contacting you asking about these dividend trades and why a certain stock that they're watching that usually does maybe 1,000 contracts a day all of a sudden did 100,000 or 1,000,000?
Yeah, we do get calls, and what happens is that, you have a lot of people have signed up. We don't have a tool like this, but there'll be large volume tools or usual activity tools. And you'll see those, and these customers that don't know will see big volume in Philip Morris. I'm trying to think of some other stocks, and even the spiders, and say, "Wow, what's going on? What's the news here?" And most likely, it's a dividend play. And I mean, it does distort the marketplace. But on the flip side, if a customer is long, deep in the money calls and they don't exercise them, we feel bad for them, and we try to notify our customers. But that's the price you pay. Customers have to be aware of what they have on and what they're doing, and because the market makers maybe are taking advantage of it. It's one of the perks of being a market maker. I mean, you have to remember one thing though. After these dividend trades go up, and if the market maker gets away with being short some deep in the money calls and collecting the dividend, there is a residual position in that trade. I mean, I don't know if it's ever happened, but if that next day the stock opens down $20, $30, then the market maker is synthetically short the puts, and they can lose a lot of money. Remember what I said before. The market makers are collecting the dividend, but they're basically shorting the put for the price of the dividend. So keep that in keep that in mind.
So yeah, moral of the story, if you're watching an underlying and it usually does X amount of volume a day and all of a sudden it jumps to 10X or 100X that, and you're wondering why, the first thing you should do, the first thing, listeners, before you check anything else, is check when the next dividend is coming out on that underlying. If you're about to go X dividend in that stock, then guess what? You have a div play on your hands, and people coming into that option who don't normally trade it, who are just trying to game the system and capture that dividend. All right, Mr. Passarelli, take us home. Give us an overview of everything we learned today about dividends and options, a quick summary, and then give us your final thoughts on divvies and options.
Well, I'll give you a summary, but I'll tell you what. I mean, usually dear listeners, usually when Mark and John and I talk, I mean, we were all professional traders, and, we know the game. We know how it all works, and we're almost always on the same page. But maybe it's the black hat, but I kind of have a little bit of a different take on this than Mark and John do. I don't think that these dividend plays are really that detrimental to the retail trader. I think that, it probably doesn't even register on the radar for most retail traders, and not that they don't realize they're losing money, but in a lot of cases, I think they're either not losing money at all or barely losing any money, because here's what happens around the X date. On the morning of the X date, let's say it's a $50 stock paying a 50-cent dividend. If you're holding the stock into that morning, you get that 50-cent dividend. But what happens is when the stock opens that morning, if the stock opens unchanged, it opens at $49.50. So basically, you go into that day with $50 a share worth of value, and if the stock is unchanged and you get the 50-cent dividend, you still have $50 a share worth of value. Now, if you are holding a call, the stock opens lower if it's unchanged, right? Which obviously doesn't make intuitive sense, but that's how it works. It opens nominally with a price lower if it's unchanged, but your call is going to stay the same value. So you don't really lose. Well, I should say your put call pair, your synthetic long stock, is going to retain the same amount of value. Now, all of that value doesn't necessarily go to the call. Some of it goes to the put. And given, the value of what a typical dividend is, I mean, it's, a small value relative to the stock, of course, what, 1% or something like that, right? The way most retail traders trade, they're not in it for pennies like market makers and professional traders are. They're in it for dimes and dollars and such. Like a lot of my retail traders, if they pay 35 cents or 36 cents, it doesn't matter to them. But if you're a professional trader, that's the entire world. That goes from a winning trade to a losing trade. So I don't know. Personally, I don't think that it's these dividend plays are that detrimental to the retail traders. I think the professional traders who analyze these sometimes think they are, because to them, Jesus Louise, pennies, the end of the world. But to the retail trader, I don't know. I think it barely registers on the radar. So that's kind of my 2 cents. I mean, if anything, just adding a little bit of color just to, I don't know. I feel it's healthy to sort of disarm some of the fear mongering that goes on by some in the industry. It's not like
calling me a fear monger, sir. Wait till I get down to Frankfurt.
I mean, bottom line is, it's not like the market makers are out to screw anybody. They're market makers. They're doing something completely different than the retail traders doing, and both can make money on trades. Market maker sells a call to a retail trader. Both can make money because the market maker hedges and spreads off risk and such. So anyway, bottom line is, just to sort of recap, with these dividend plays, they used to be a big thing. Like when I started trading back in early 90s, when the guys would come around to do dividend plays, I would do those, and you might make a few $1,000s on them. But by the time I left the trading floor, it was just so saturated with dividend plays, and everybody was so savvy that, if you made enough on doing a dividend play to cover your commissions, you were really, really lucky.
The fees were just outlandish for that kind of thing, and that's one of the reasons why, a lot of market makers didn't do them. Now that the fees are capped people are coming in who aren't market makers. They're just outside firms who have discovered these little pennies being left on the table by the retail guys, and they're trying to scoop them up, essentially. There are obviously a lot of different takes for the divs trade side. We can probably debate this for quite a while. Moral of the story is a lot of volume going up that doesn't really reflect any economic activity. So you, the end listener, really should just put that out of your mind when you see big volume on right around an ex-dividend date, because you know that it's just a div play. It doesn't represent anything you really need to know about the underlying. It's not a bunch of insiders loading up on upside calls or anything like that. Moral of the story, too, when we're talking about dividends, let's do a quick summary here. If you have an underlying and they declare some special surprise dividend or a dividend down the road, what's that going to do? It's going to hit the price of the stock, and so in turn it's going to decrease the value of your calls, make your puts more attractive. So just keep that in mind, a general rule of thumb. Second rule of thumb, when you're looking at whether you need to exercise or not, look at the value of the put on that strike. If the dividend is worth more than that, then guess what? You want to exercise because it's worth your while to do so. If not, then forget about it. It's not worth your time. So just a couple quick takeaways of dividends and options. If you want to learn more about any of this stuff, of course, we have a bunch of write-ups on dividend plays, and we have a bunch of write-ups on how dividends impact options on the optionsinsider.com. You can, of course, check it out there for yourself, or call up a guy like Dan or a guy like John, and they'll be happy to walk you through it at length, preferably at 2 a.m. on their cell phones. That's when they're really, really happy to do so. All right. And with that, we're going to keep on rolling right on into our next segment, the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, and welcome to the mail call. This is, as the man said, the portion of the show where you guys get to take over and take the reins and let your questions and comments be known. And let me just start off this mail call with a quick apology to those of you who may have used the website feedback form on the Options Insider to send us your questions or comments. For some reason, there was some glitch in there. Sporadic questions weren't getting through. And we discovered it this weekend when a whole bunch of them got dumped on our servers from the better part of the past year. So if you sent us something through that feedback form and we didn't respond to you, didn't hear it on the show, we weren't ignoring you. We just didn't see it. That's since been fixed, and we now have a bunch of questions from you guys that we want to make sure that we surface here on the show. So we're going to get right to it, starting off with a question from Mr. Glenn Baker. John, this one's for you, it sounds like, so put your listening ears on. He writes, I've been listening to Options Bootcamp since the first episode. I've also been listening to Option Block for about 2.5 years. I currently have a Schwab account where I primarily buy mining stocks. I would be interested in possibly switching to Sogotrade for the lower commissions. Does Sogotrade allow you to buy stocks on Canadian exchanges? Thanks, and I really enjoy the show. What is it with Canadians and resource stocks? It's kind of like the thing they all love to trade up there. It's part of their national DNA, I suppose. So, John, what do you have to say here for our friend? I know Canadian stocks are still a little bit difficult for a lot of U.S. brokers to really include in their accounts, but I know a lot of firms are looking into it. Is this something Sogotrade is looking into as well?
Yeah, we're always looking into it, different exchanges, and the bottom line is now that, we don't allow it, but I think there's a lot of different alternatives, for this customer to trade the mining stocks and the commodity stocks, and get exposure to that without having to do exclusively, stocks that are on the Canadian exchanges. I mean, most of the big Canadian stocks are going to be, listed in New York or, over the counter. So, we're always evaluating, we're always looking into it. But at the current time, we don't specifically allow customers to trade on the Canadian exchanges.
Those Canadians, always out of luck, it seems. Thanks for listening to the show there, though, Glenn. In the meantime, we're going to roll on to our next question. This one comes from Troy Charles. He writes, my question is for Bootcamp regarding expiration and assignment. I was recently long 5,000 shares of a stock and short 50 of the $3 calls. The stock closed last Friday at $3.02, so I assumed my stock would be called away. Imagine my surprise when I woke up Sunday morning to see that I still had 1,500 shares in my account. How is this possible? I thought automatic exercise occurred if the options are a penny or more in the money. Can a broker change the automatic exercise threshold? The option is relatively thinly traded, about 1,600 contracts open interest. Could that have something to do with it? Signed, Puzzled in Pensacola. So this is an interesting one, and this gets back to something we talked about before on the show when we talked about exercise and assignment, that he is right. The automatic exercise threshold for equity and index options is a penny. It was reduced from a nickel to a penny a few years back. So if your option is a penny in the money or more, it should be automatically exercised. But there are a few scenarios where this doesn't occur, as our friend Shore here just found out. Dan, why don't you walk us through some of the scenarios here? If this exact scenario could unfold where you wouldn't get assigned on all of your calls, even though they're a penny or more in the money.
Yeah, I mean, it stems from the fact that the word option means option. If you buy a call option or a put option for that matter, you have the option, you have the choice of exercising or not exercising. Now, that being said, yes, the Options Clearing Corporation rule is, hey, we'll do you the favor of automatically exercising if it's a penny in the money, unless you tell us not to. And sometimes a trader who's holding the position will tell them not to. It's called a contrary exercise form. I believe that's what they used to call it anyway. Contrary exercise advice form. So why might somebody decide to not exercise something in the money? Could be a number of things. Two things that immediately come to mind is you get to decide whether or not you want to exercise until a while after the close. I mean, it depends on your broker. Every broker sets their own rules, but I imagine it's at least a half hour anywhere you could imagine. And so what if bad news comes out right after the close and the stock's trading at 275? Well, do you really want to own it at 3? No. So you're going to call up your broker, who's going to call the clearing firm and say, hey, this guy does not want to exercise. Another thing could be market makers. You know, market makers who have long options at expiration, they're in a tricky situation sometimes. Like what market makers strive to do is have no position at the money at expiration, because they don't want to have pin risk if they're short, and they don't want to have to make a decision if they're long and lose a bunch of time decay. So if a market maker is long, like calls at expiration, he wants to start Monday morning flat with no position. So he might forego a couple pennies, you know, and say, hey, listen, I know I could make 2 cents if I exercise this, but then I'm going to be long deltas coming into Monday. So forget it. I'd rather, you know, lose 2 cents than risk the stop gapping lower, you know, 50 cents on Monday and lose my shirt. So those are two reasons that, you know, come right off the top of my head why somebody might not exercise long calls.
John, let's touch on his other part of his question really quick about, can brokers change that automatic exercise threshold?
I mean, I think it's very rare. I'm not even sure if we can. I mean, the one thing that we can do is we can always put a do not exercise request in, for, you know, or instruction for the customer. But, you know, the thresholds are, you know, are now a penny, and that's problematic, because in the past they used to be a nickel, a dime, and Mark and Dan would, I think at one time were they even more than that. The threshold, now they're a penny, and we're always nervous, or I am, during expiration. What's the official close? You know, I have 3 or 4 different sources now that I look at, different platforms to say, hey, what's the official close? Because, you know, we have to be very careful. And our clearing firm also, you know, in the past, Dan, Mark, maybe can speak to this too. If I wasn't sure, if I was a trader, I wasn't sure what the closing price was, I would call up and say, hey, you know what? Do not exercise these calls or these puts. And they would put it in, even if they didn't have to. But now we get a lot of brushback from our clearing firm saying, "Wow, this wasn't in the money. Why are you giving us this extra work?" So, you know, just be very, very careful. And if you see an option that you can close for a few cents, I mean, please do it. I don't know what else we can say. All you're gonna do is get yourself in trouble. And for all the money you may save by not buying things back, the one time it's all gonna get wiped out.
Yeah, we've said that from bitter experience, all of us listeners. So learn from our pain, learn from our mistakes. All right, next up, we have a question. Comes in from the mobile app. Love to see people using the mobile app. From a listener, Nick Snow. He writes, hello. First, thanks for all the shows. I used to listen to Options Insider years ago, somehow lost the podcast, and recently found it again. This name sounds familiar. I believe this guy used to write into our shows back in the day as well. So good to have you back here, Mr. Snow. And he writes, the good news there is I have been listening nonstop for the last 2 weeks. Second, for the real reason, I have been trading for a while, retail only, and in listening to your shows, particularly Bootcamp, I have heard, quote, close your credit positions if I had a nickel for every time a person came to me and said this crazy event happened and it wiped me out, end quote. John, that sounds familiar. You just said that right now. Nick goes on to say, I do close my credit positions at between 20 cents to a nickel every time, but I have wondered if outside of the commission has anyone ever done a risk reversal or roll down to a lottery ticket. For example, I sell a bull put or a bear call spread. I go to close the position at 80% of my profit, and there's a day or two left. If I just close my short leg and left the long leg on, or even just swap my short leg for a lower short, now making my spread a debit, albeit a super cheap debit spread, lottery ticket, I could capture those freak events that you always talk about. By my count in Options Bootcamp, I would have 128 nickels for those freak events you mentioned. Any thoughts? Am I missing something? Sincerely yours, Nick. Well, Nick, first off, I'm glad to see that you're heeding our advice and closing out those winning shorts. That last nickel, that last dime, it takes so much longer to collect than the rest of it, and it's so much more risk involved in getting that last dime, last nickel, that it isn't worth your time or your effort to really go after it for all the reasons we've stated on this show many times in the past. But his idea is an interesting one. If there are so many of these freak occurrences, it might be worth rolling to a bit of a debit spread just to try to capture them every now and then. On the downside of that, the problem with that is they are freak occurrences. They don't occur very often. You don't see a lot of firms, let's say, doing a last-minute extreme dividend announcement on the Friday of expiration. It does happen, but it's very freakish, or a firm coming in and doing an early announcement of really, really good revenue, or vice versa, really bad revenue, predating their earnings a little bit. It doesn't happen very often, so you would mostly be wasting 128 of these nickels on those scenarios. That said, if you have a name that may have a history of some of these weird, wacky developments, and you have some shorts that have gone your way, and you're playing with house money, for lack of a better word, and you don't mind spending maybe a nickel of that to try to capture that, I don't see any harm in it. But be aware that the vast majority of the time, like you said, these are lottery tickets, so they're probably going to lose. Mr. Pastorelli, what's your take on taking your winnings off the table from a short perspective and then flipping maybe to the long side to try to capture some of these extreme movements?
Well, I mean, I don't necessarily think it's necessary to flip over to the long side. I mean, don't get me wrong, it doesn't hurt, but I definitely tell all my students every single time, always close your shorts. I mean, it's risk reward, whatever the option your short is worth right now is the most you can make from that point forward. But what you can lose can be huge, especially if it's a naked option. So every day you have to consider the risk reward at this very point in time. If you can buy a naked putback for 2 cents, knowing that if something highly unlikely happens, a negative lottery ticket happens, or just like something totally off the wall, totally unexpected happens, you can lose, you could lose a new car worth of money from your account when you're trying to make, 2 cents, which translates into $2 green, so close it. There's no point once the risk reward is no longer there.
Yeah, it makes sense. I think a lot of people do what you say anyway. They have a credit spread that's gone their way, and they just close out the short leg. So that kind of is doing what you're talking about here anyway, and you kind of mentioned that as well. And then you just leave the long on if you really are concerned or want to try to capture one of those crazy movements. You're probably only going to get a penny or two for that long late anyway if it's really out of the money. So it may not even be worth your time or the commissions to try to close that part out. So you just close the short, take your money, leave the long as a flyer, and then you're not spending any extra money. Maybe cost you a penny extra in not getting that leg closed out. But at the end of the day, you still have that long component if you want to have that high flyer. So that's probably the way I would go with this, rather than trying to reestablish another spread or get long a different lower strike or anything like that. Why spend extra money at that point? Just keep what you have on, close out one portion, and let the rest ride in case the worst does come to pass, in which case that's a home run for you.
We had a customer that was trading a symbol, but it was about $100 price, and the stock was, I think, 78 before earnings. Earnings came out was 95. He was long the 95 100 call spread. He sold he called me up. He asked what to do. I gave him my advice. He didn't take it. He sold the 95 calls, I think $3, and then said to me, "Well, I'm not gonna I'm not going to buy back the hundreds. They were like 20 cents at the time, and he didn't. And then the next day, the stock was 106. So, it wasn't like 130. It wasn't some crazy price, but he, for a 10 lot, for $200, he lost like $5,000. So, these outlier events happen more than you think. I mean, this is a very, very recent. It was a high-flying stock, but, things can happen sometimes. And he got a little greedy, and, he had a great winning trade. It was a few $1,000 winning trade that went negative because he was unwilling to spend, $200. The advice to buy back the short, like you guys are saying, is just wonderful advice. I love buying back the short and keeping that lottery ticket because you just never know when something's going to happen. You just never know.
I'm going to try to squeeze a couple more questions in here. Like I said, some of you have been hanging on for a while with these questions, so I want to make sure we get to you guys as well. Here's a quick one from Abe. He writes, can you make an episode on how to repair losing options trades? I enjoy listening to your show. It keeps me going while I'm slaving the night shift at work. Thank you. Well, Abe, good news for you. In the, I think, a few months since your question came in and got lost there on the website, we actually have done that. If you go and check out the recent episode we did, episode 41, and 40, those are the option adjustment episodes we did where we talk about how to adjust winning and losing option strategies. So we get into that in a great deal of detail on those two episodes. And then if you want more of stock repair type stuff, you can go back and check out episode 31 from October of last year, where we get into all different ways that you can use ratio verticals and things to repair a losing stock position. So there you go. 3 episodes getting into all sorts of adjustments and repair strategies. Hopefully that helps you there while you're slaving away at the night shift. Hopefully that job isn't too painful there. Thanks for writing in and for being patient. Next up, we have a bit of a long one. I'm going to try to truncate it a bit to squeeze it in, but it's all about dividends, so it's kind of topical for this episode. This question comes in from Greg S. He writes, I'm looking for some advice from an experienced options professional regarding stock replacement using American-style calls. Well, I'm sorry, Greg, you've written into the wrong program. No professionals here. No, of course, just kidding. He goes on to write, really, the question comes down to, for a higher dividend yielding stock, should I be buying a leap or rolling out approximately every 3 months after exercising very close to expiration and capturing each dividend? I get that the dividend lowers the price I pay the longer dated options are, but does not reflect as much as if the options were available as European style. It seems that the dividend yield is high enough. The American style can't fully compensate because the option can't drop below intrinsic value. And he goes on to a pretty detailed discussion of warrants and European style expiration. At the end of the day, the question kind of boils down to, if you have a stock, like I say in the example he gives, he's been rolling in the money call option positions on a relatively high dividend yielding name, about 5 to 7% annually. I've wanted concentrated exposure as part of my overall portfolio, but with limited risk. It makes regularly scheduled quarterly dividend payments, and the timing of the annual increases is known to occur in Q1 each year. So that's the example he has. We can apply that to pretty much any name in a similar scenario. What he's asking is it worth your while to do exactly what we talked about, which is to exercise every quarter to try to capture that dividend and do 4 options every quarter, so 1 every quarter essentially, versus just saving yourself a lot of time and hassle and going out and buying that leap. He's referring, of course, to the stock replacement strategy that we've discussed on this show many times in the past. A great strategy. If you have a name, you don't want to outlay all the money that is required to buy the stock or buy it on margin. You can instead buy an in-the-money call and use that as your surrogate for the stock. But again, remember, as we just discussed, if you're doing that, you're not collecting this dividend. That's what he's writing in about. He wants to know and say, this is a great strategy, but I'm not collecting this dividend. Is it worth my while to do that? And this type of scenario, it usually can be worth your while to do that. Sounds like a pretty savvy listener. He's pretty familiar with the math and how it works. And if you're competent enough and comfortable enough doing this and rolling this and exercising every quarter and then rolling and doing it again the following quarter, I don't see any reason why you shouldn't do this. You are, again, collecting the dividend. Sounds like from your letter you've done that little rule of thumb we've talked about. The dividend is indeed worth more than the premium you have on that put wing, so it's worth your time to do it. In which case, if you were doing the long leap instead, you wouldn't be getting all those dividend payments. So there is a little bit of a difference there. Of course, you're getting that reflected in the price of the call option as well. So you're getting some of that back in the price of the call. But at the end of the day, like we say, with writing options up front versus writing a leap, it still is better to kind of do it a little bit nearer term and try to harvest that dividend on your own if at all possible. John, what's your take here for our friend? I know it's a pretty intricate question, pretty detailed question, but what's your take on that basic subject matter? You think someone in that scenario with that kind of a high dividend yielding stock should be exercising that call every quarter, or should he just say the heck with it and go buy the leap because it can approximate most of what he'll be getting from exercising and capturing the dividend?
I mean, I think this customer, we love to have customers that are as thoughtful as this customer. And I don't really know. I mean, I'm interested to see what Dan thinks on this too. But I mean, when you have a customer that's just thoughtful and puts so much, thought and time into a question or his positions, our best customers are the guys that call me every day and ask questions like this. And there maybe is really no right answer. It may be just the feel or your experience or this or that. I mean, I would really, like to see what Dan thinks about this.
Mr. P, what is your take here for our friend Greg S.?
Yeah, well, Greg, look, I mean, you're on the right track. I mean, here's the bottom line. What I love is I love guys like you who come out there and you put in the time to figure out some of these little nuances. I mean, man, in the long run, it's just going to make you a better trader. It's going to make you more successful. So, I mean, I'm just your cheerleader here for actually recognizing some of the risks, putting in the thought into it, and and I otherwise just basically agree with what Mark said.
Yeah, like I said, it looks like you've done most of the homework already and kind of answered your own question a bit here, Greg, with a lot of the extra detail you put in with the CBOE calculator and whatnot. We don't have the exact name. He doesn't mention in here, so we can't really follow up with his numbers and do our own analysis. But essentially, in this scenario, it usually will pay to do it. Again, you will get a good chunk of that by buying the leap as well, because that will be priced in. There is no free lunch in the options market. If you have an option that's not going to collect that dividend over the year, that's going to be priced in to the value of that option. So you will get, there's no rule of thumb how much you're going to get on that. You'll get a good chunk of it by buying the leap. So you're not missing out on too much. Sounds like from your letter here, you're the kind of guy who wants to squeeze out every last dime and nickel from these trades. Then you will do a little bit better by rolling the calls. Probably a good exercise to get into, too, to kind of do that work every quarter, to do that analysis, and to get a little bit more understanding of the underlying, how it works, how the dividends are structured, how they impact the options prices. So listeners at home, even if you don't have a name that really pays a lot of dividends, it might be worth looking at some names that do pay high dividends, see how those calls are discounted versus the puts, see how that really factors into the option pricing. Maybe you go find a name that recently announced a surprise dividend and look at some of the options pricing, how it changed the day before and the day after the announcement. You can kind of do some of that math yourself so you can get a little bit more of an intuitive understanding of how dividends play into options pricing, because they are a very big component of how options work and how they are priced. If you want to maximize your options trading, a key understanding of dividends is very important. All right, great question here, Greg, and to everybody who wrote in. You guys keep them coming. We love this kind of feedback. You guys are really the reason that we do this show, and to hear such great feedback and such great questions, it's really fantastic. So we love it. Keep it up. And unfortunately, that's all the time we have for the mail call segments, also all the time we have for this episode of Options Bootcamp. But before we go, let me check in really quickly with each of my cohorts here on the old Bootcamp Drill Instructor Squad to see what they have cooking in their respective necks of the woods that may interest you, keep you occupied until we all can gather here together again on the old Options Bootcamp program. Starting off with you, John. I know a lot of stuff cooking over there in Sogotrade.com. So what's the more top-of-mind stuff? What's coming up that a lot of our listeners can look forward to?
We're doing a webinar with the OIC in the end of April. So it's the first webinar we've done in a long time. I wanted to get the optimizer, our margin, all squared away before we started to make the big push. So we're really excited about that. Once we get that going, we're going to probably do more of those. We have our lead platform coming out, the famous lead platform. And our mobile is about a month away. So we have a lot of exciting things coming, for the springtime.
And Mr. Elite, what is cooking in the land of MTM?
Well, there is actually something really special cooking in the elite land of MTM. This is our 6th year in business, and we have had customers since the day we started practically saying, hey, when are you going to do a live in-person class? And guess what we're doing? We're doing a live in-person class in Chicago in June, and it's going to be really, really great. We're just announcing this right now at this time, and we would love for you to be a part of it. So you can go on over to markettaker.com/Grand Slam, all one word, _Chicago. markettaker.com/Grand Slam _Chicago.
It must be big if it forces you to leave scenic and sunny Frankfurt. I don't know if you know his listeners, but Dan is painfully socially phobic. Probably because of that big scar on his face. He doesn't like to leave his house very much. But
the one you gave me, Mark?
Yes. Well, we shouldn't have been sword fighting after having a few beverages that day. Live and learn, right?
This actually is a really special event. It's really great. It's going to be held at the Chicago Board Options Exchange. There's going to be a floor tour involved. There is actually, it's called the Grand Slam because there's a rooftop Cubs game reception following the event, so you can kind of meet some other traders and, meet some people that you can share trade ideas with, and while enjoying dinner and beverages while watching the Cubs lose.
Sounds like a plan. You want to learn more, listeners, surf on over to markettaker.com and click on the link there, and you can register for that and all that fun stuff. And while you're surfing the web, of course, surf on over to Sogotrade.com. Kick the tires over there. Check out all the fun stuff that John's always talking about, what they're working on over there at Sogotrade.com. I think you're going to find it pretty interesting. And on behalf of Dan and John, and of course myself, I want to thank all of you guys out there in the listening audience for downloading and streaming and subscribing, and of course for writing in and being so patient with us. We'll get to your question. Don't worry. Keep them coming, though. Don't turn off the spigot. We love these questions. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogotrade, an extraordinary value in online trading. Why pay more for the same trade when Sogotrade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.